Welcome, everyone. My guest today is Managing Editor James Kleimann to talk about Homepoint and what went wrong in their cost structure and operations that led to their demise. James, welcome back to the podcast.
Hey, good to be back, Sarah.
Great to have you back. I always like to ask you about what's going on with lenders, especially the big lenders in our space. And we have quite a bit to talk about this time because your reporters have been talking to executives at Rocket, at UWM, former employees at Homepoint. So we have a lot to talk about, but I wanted to kind of kick it off with one of the most recent stories, which is how much IMBs are making or not making in this market.
Yeah, they're not making. So we just got the numbers out from the Mortgage Bankers Association. And you may remember that in the fourth quarter, the average independent mortgage bank lost about $2,800 per loan. And that was easily the worst ever showing. They lost, I think the net adjusted loss was 99 basis points. Again, a record, not a good record. So the good news is the losses narrowed pretty significantly. They narrowed by about 35% in the first quarter. So the average independent mortgage bank only lost about $1,970-ish in the first quarter. So that's not great. But again, that's 35% better than the fourth quarter. And I think it does speak to this idea that we've talked about, that a lot of people in the industry have talked about, which is we've already reached the bottom. Things are slowly but surely improving, and they couldn't get much worse. And so, that there are silver linings. However, revenue was up. The MBA is projecting a much more bountiful second quarter than the first quarter. And the revenue that companies were making from servicing was down a tick from the prior quarter. So it does suggest that there's hope in terms of the origination market improving. That said, no one would argue that the average independent mortgage bank is out of the woods. We're still looking at a nearly $2,000 per loan loss in the first quarter, and only, I think it was 33% of those companies were profitable in the first quarter, which was better than the prior quarter when only 25% of IMBs were profitable. But there just aren't a lot of businesses that can sustain losses for that long. And now we're looking at more than just 2 quarters. They haven't been profitable really since kind of mid 2022. And these are not businesses that are built in most cases to retain profits, right? The whole business is you get your warehouse lines, you get the customer, you get the loan, you get them off your books in a month or two, and then you find the next customer. Well, when you can't find the next customer and your costs are much higher for a myriad of reasons, it's really hard to do that in the long run unless you have pretty strong capital reserves, or you have access to other capital, or you are absolutely ruthless operators and you're able to just, cut your way to, if not profitability, at least a break even. And that's pretty clearly a struggle. And I think we're still going to see big losses in the second quarter when those numbers eventually come out, later in the summer as well. So the question is, why haven't we seen more M&A activity? I think we're probably approaching that period, but it's still been a little bit slow out there. But we have certainly seen some companies go under. So that's not going to be a trend that's going to end anytime soon either.
No, and that really brings me to the next story that I wanted to talk about, which was Flavia Furlan Nunez's really deep dive into Homepoint. And the headline is "The Homepoint Post-mortem, How One of America's Largest Mortgage Lenders Went Bust." And it's an excellent, really deep dive. She talked to a ton of people who had formerly worked for the company, and then also, other people, analysts, things like that. So, let's do the post-mortem here. What is, from your perspective, what's the headline on what made it that Homepoint just couldn't keep going?
Yeah, I think there are a lot of people in the industry that might reflexively look at Homepoint failing, for lack of a better term, and looking at UWM and its aggressive pricing strategy as being the reason that Homepoint was not able to survive in the wholesale channel. And they'll look at Loan Depot, which decided it no longer wanted to operate in the wholesale channel. They'll look at FOA, which also left the wholesale forward operating channel, and they'll say, okay, so hold on, we have now 3 of the 10 biggest lenders in this channel are no longer there, and we have one of, the biggest mortgage originator in America that has more than 50% market share. Well, it just meant that Homepoint wasn't able to compete with that company. And to an extent, that is true. The way I see it, the way a lot of the analysts and former employees at Homepoint see it, is UWM's aggressive pricing strategy absolutely harmed Homepoint's ability to be the number one mortgage lender for a sizable portion of mortgage brokers. They had already tried the correspondent model. It didn't work for them. They gave it up. They went all in on wholesale. And at the end of the day, they weren't able to convince enough customers, mortgage brokers, that they should be sending Homepoint their loans. And so, yes, part of that is UWM is a much more efficient operation, and they were never able to achieve such operational efficiencies. They also had other pretty significant flaws in just operating as a mortgage company. And I think it's worth remembering that these companies largely do the same thing. A mortgage company, for the most part, is going to be, depending on the size, depending on the location, depending on several factors, they're probably going to be very heavy on Fannie Freddie, maybe a bit of FHA, maybe a little bit of non-QM, just to, get a couple brokers who are looking to do maybe like construction or bridge loans or whatever. Like, they'll have a couple more exotic products out there, but the business is mostly conventional mortgage loans to the average home buyer in America. And that means that really, if you have the same product, if the rates are mostly driven by the secondary market and other factors, how do you, as a mortgage originator, make money? How do you stay in business? Well, it really comes down to efficiency. And Homepoint never was able to achieve efficiency to the point where they could reliably have profitable quarters, even in non-great mortgage environments like 2020 and 2021. So the wheels really started to come off in an operating sense in 2022. And that's true of a lot of companies. Homepoint is by no means unique in that regard. But Homepoint also, according to the analysts, really struggled because their capital position was not very strong for a publicly traded mortgage company. And being a publicly traded mortgage company offers so many advantages just in your ability to raise capital, your ability to, operate across multiple channels and work with investors and get, more than just warehouse lines for your customer base. It just gives you a lot more in terms of debt structuring that isn't available in a lot of cases to privately held entities. But because Homepoint was heavily backed by a private equity company, when they did go public in January, they were not really benefiting from the money that was raised. The private equity company took a lot of that money, and that's what they do. They take the risk of backing a company and they bring it public, and then all the money that they pumped in and all of the risk that they took is rewarded by their ability to sell the stock and leave, right? And Stone Point Capital, the private equity backer, they were still the owner or the majority shareholder of Homepoint when it sold. Homepoint Capital, the parent company, sold to Mr. Cooper Group for about $324 million. So they were still involved, they were still active, but it put them on a weaker standing when the market turned and they had to really be smart with their pricing, and their capital market strategy had to be impeccable. Their underwriting had to be as good or better than their bigger competitors, and it wasn't. And so well, we can get into more of the details, but in the end, they didn't have enough capital. Their operating costs were too high. They needed to hit 90 basis points to turn a profit. And in some of the quarters they're at like 22, they're at 12. They're just so far below the line that there's no way they could have possibly made that kind of money. And it just sort of ended. Not, I think, unsurprisingly, there were rumors that they were going to be sold. Really, the value toward the end was just their mortgage servicing rights. And that's really what happened. So we can get into a few more details as well, because there are some really interesting, operational issues that I think should be discussed.
Right from the beginning, their IPO, they didn't raise nearly what they thought they were going to raise when it came in
Yep.
at like 13, and they were thinking it was going to be more like 19 or 20.
Yeah, they ended up trading at $13. They wanted to raise, I think, more than twice what they ended up raising. They raised, I think, about 90 million in the first go, and then they did a subsequent debt raise, but that was really the only beneficiary of that was the private equity backers, the kind of preferred investors. And so Homepoint never had enough money to really go toe to toe with the big boys. And that's fine. Like, you don't have to. Not every mortgage company in America has to go toe to toe with Rocket or UWM. But certainly didn't help in a channel that was extremely difficult to win in 2022, and remains really difficult to win in right now in 2023.
Let's talk about the IT department, maybe some of the IT struggles they had, because that was something that former employees really surfaced, that they felt like that was one of the hindrances here, one of the things that led to the failure.
Sure. So Homepoint, like a lot of other mortgage companies, they didn't want to build all of their tech in-house. They didn't want to maintain an entire division of programmers and software developers. And so what they did is they went with a white label, semi-customized system with ICE's Encompass. Again, that's a pretty normal thing. That's not weird. A lot of them just get it off the shelf. And that means that ICE is really responsible for making sure that the upgrades work and that your staff is trained and you know how to use the system properly. Because they did a semi-customized version of Encompass, they required their own dedicated IT team, and it numbered about 160 people. And that's a pretty significant workforce. And they also had a lot of problems with the software system. It would go down. There were periods in which people were locked out of the system. There were periods in which there was a lot of confusion between different departments. And it wasn't the only reason that Homepoint struggled operationally. And we can talk a little bit more about some of the others. But I think when you have a company that is around 4,000 people and it shrinks very rapidly because the rate environment changed drastically and in record time. And in turn, Homepoint got much smaller. They started making cuts in like summer of 2021, I think, something like that. So pretty quickly after they went public, they were already making cuts and restructuring and reorganizing. They had a lot of seasoned mortgage pros, and a lot of those people got wiped out in those layoffs. And when they did, rehire to fill in some of those gaps, they would hire people who had no experience whatsoever in mortgage. And then they also had this big dedicated tech team that was, really there to just keep the lights on and make sure that the LOS was actually functioning. And it just created a lot of operational inefficiencies, created a lot of confusion between different departments, and it made the time in which a loan was originated much longer than it should have been. And you also have to remember that in some markets, the pandemic effects never really went away. There are still multiple bid situations. There are still lots of areas that have so little inventory and still enough people that have money and still want to buy a house. And so depending on where you are, you still have to be really efficient. You have to cut down your, time to originate to 15 days or 20 days or whatever, but it has to be competitive. And in some cases, because of the combination of tech issues and just a lot of experienced people leaving and a lot of, uh, you know, people who knew where the coffee was in the break room, just weren't there. And it's hard to, I think the tech adage is like flying or learning to fly the airplane in the air, something like that. And it's, that airplane usually crashes, right? So it's a really unfortunate situation, but the people that I spoke to, that Flavia spoke to, most of them knew that this day was coming, and they knew well before we first reported that Homepoint would be selling its originations business to the loan store.
Hi, I'm McKenna Clay, Events and Program Specialist here at HW Media, and I wanted to invite you to our upcoming event this summer. A theme we've heard from housing leaders this year is the importance of relationships to not only survive, but be strategic in 2023. And that's why we decided to invite the top C-suite executives and leaders in mortgage to join us at Gathering of Eagles in Austin, Texas from June 18th until 21st. Now, Gathering of Eagles has historically been exclusive to the nation's most elite brokerage, association, and team leaders and C-suite leaders. But for the first time this year, we're opening up the audience to include execs from mortgage, title, and insurance so that you can connect and build vital partnerships for your business. If you want to learn more, visit the events page on realtrends.com, and you can get registered today to come hang out with us in Austin.
I think that's one of the things that really struck me about this story, that we know that so many companies in mortgage, in real estate, actually, lots of industries right now, but especially in our industry, are having to deal with, they don't have the budget, so they have to lay people off. But what that means is the people left have to do two people's jobs sometimes, right?
Yep.
Or, maybe the brain trust left and on these particular things, or maybe the experience things. One of the things that Flavia noted was that when they laid people off, or when people left, really experienced people, they're not going to be filled. That job's not going to be filled by somebody else who comes in with that sort of experience, because that person already knows, like, okay, there's layoffs. I mean, you're not attracting,
Sure.
it's hard to attract the best talent when you're having massive layoffs. It's also, if you're in a budget crunch, you're going to go now to somebody who has less experience. And so cumulatively, when you look at how many people they had to lay off over that, since 2021, it has an effect on the entire operation.
Yeah, and I think for the people that remain, it's also, you remember when the good times were rolling. And so Flavia spoke with a processor who had been there at the beginning. I think she was hired in summer 2020, and she had never made the kind of money that she had made at Homepoint. She was, with the bonuses, she was making about 117,000 a year as a processor, which is really quite good, really, really solid money. And she survived a couple layoffs, and morale started to turn. You miss your coworkers, right? When they're good and they're competent, they make your life easier, your job easier. It's hard. It becomes a bit of a vicious cycle, and they stopped doing bonuses. They would set an extremely high bar for bonuses to be rewarded, and then they couldn't work overtime. And then after that, they started to limit the number of files that the processors were able to work on. And so they just ended up gradually being unable to execute the strategy that the executives had set out. And again, because they had this very high cost basis, because they had to reach 90 basis points, it's really a question of math. When you look at what the Federal Reserve's policies did to the mortgage market as a whole, who out there in wholesale is hitting 90 basis points anywhere? It doesn't happen. It just does not happen. And so this was inevitable. But it is sad. Flavia and I both spoke to a number of people who worked there at the beginning and survived a number of layoffs, and many of them talked about how great it was as a place to work. And mortgage companies in general have a reputation for chewing you up and spitting you out, and are full of hard charging type A people, and not always the easiest places to work. And it's not an easy industry. And the fact that so many people spoke about how great and experience they had in the early years at Homepoint, really until the summer of 2021, fall of 2021, when things started to change, and the company's strategy took kind of a different approach. They loved it. They really loved it. Having said all of this, I do think that there is an opportunity for the people who are leaving to go to the loan store to learn from the mistakes that Homepoint bore, and they won't be saddled with the high cost that Homepoint ultimately was probably never going to be able to shake unless they radically changed the model, unless they ended up going private themselves. And that was not going to happen, of course, with private equity backers in that position. So there are opportunities. And if you look at the wholesale channel landscape right now, there's a pretty big opening, I think, for a wholesale only lender that has good pricing, that has good tech, that doesn't require a staff of 160 people to fix whatever breaks that day. It's like those in journalism and publishing could probably tell you nightmare stories about like customized CMSs where you write your stories, you file your stories, and like, oh, the image doesn't load, or oh, the SEO doesn't save, or I got locked out and my entire story got deleted, or that there are nightmares that many of us vividly remember. And I think it's a similar situation when you look at some of the LOSs in the mortgage landscape. And so I don't think that the folks at the loan store are going to make the same tech mistake. They're not going to have the same high cost basis. They're going to have hopefully motivated staffers who don't have, I think this feeling of, oh God, the inevitable is going to happen. Right. I think this is a very different moment for them, and hopefully it's one of opportunity and excitement. And I think it's good for the mortgage space in general to have another really strong lender who's only looking to work with wholesale brokers. And they're going to do some correspondent as well, of course. But I think it's pretty interesting, and we're going to be following them. We have a couple interviews lined up with the executive team at the loan store coming in the next month or two. And still, it's sad that Homepoint ended up not being able to make it to the finish line. And we'll see if anybody emerges beyond the loan store. I know that Caliber Newres has an opportunity there if they really want to get bigger. I think Penny Mac probably has an opportunity if they want to. Of course, they're easily the biggest in correspondent, and it's a little bit different, but they've been pushing some broker tools and technology and really trying to hammer some of those initiatives home. So there are some lenders out there who could make a little bit of an appearance in the IMF top fives, but I think UWM is really broken away from the pack here. And even if they don't maintain a 54% market share in wholesale, they're probably going to remain very high in the 40s, 50s for the foreseeable future. I don't see anything changing there unless they end up really changing their pricing. Their pricing is still pretty good. It's not the best in town anymore, but it's still pretty good. And I think they definitely have a lot of diehard fans who are sometimes criticized as being effectively like retail arms of UWM because they're sending 90+% of their pipeline to one lender. And then the question is, are you a broker if all you do is business with one company? But still, UWM is dominant. They're going to remain very dominant for the next couple of years, I think, at least.
I really appreciate the way that Flavia went into the detail there, because like you said, it's easy just to go, oh, well, it was all about the pricing. It was all about the fact that, UWM squeezed them. And yet, like you said, I mean, if you're a mortgage lender and you're having a hard time in 2021, that's a big red flag, right? 2021 should have been a time when you could have, made sure that you were making money. 2022, we all understand how that goes.
Yeah, but it's relative as well, even in 2022. When you look at the last quarter, I believe the gain on sale margin for Homepoint was something like 12 basis points, and UWM's was 92. Now, in the last 2-3 quarters, we heard from a lot of brokers that said we stopped sending any loans to Homepoint because operationally it was so difficult. And one day my account executive's there, the next day he's not, and then there's someone new, and then they had so many problems with underwriting at Homepoint that they needed to build an in-house audit function so that you'd basically have two underwriters looking over every file, because Fannie and Freddie were starting to get very, very frustrated with some of the underwriting issues. And we know that there are larger repurchase issues in the IMB space, but Homepoint was definitely one of those on a very informal, like, guys, get it together list.
Well, and it's just such a snowball. So once, once you have people who are, I can't trust the underwriting or the time to turn it around or the customer service, then, it just snowballs into more of a problem for the lender.
Absolutely.
Well, interesting. I love that the newsroom is looking at all of the, they spend a lot of time looking at the strategy that different lenders are operating under and what they're doing. We've had deep dives with UWM. We also have one with Rocket, which I would love to dive into next week since we're almost out of time here. But I think it's really important right now to kind of step back and go, okay, we can see what's working, what's not. And if you're reading our coverage, you can maybe see that a little bit ahead of time, right? Because we are definitely, we're trying to get to the bottom of, like, what are people's cost structures? Obviously, it's much easier when they're public companies. We can do those kind of deep dives. But even so,
please go public. Everybody, please go public.
we get so much more information that way. But also just stepping back and going, what does it look like from the top down, and really look at what is their strategy in this sort of market. And, we said from the beginning, there's going to be winners and losers in this market. And sure enough, so like you, I hate to see any company go out. So hope those good folks can, have gotten, jobs through the loan store. I know there were other people that she talked to that hadn't found jobs yet.
Yeah. And there are a lot of processors and sort of the back office staffers, not just at Homepoint, but look at the landscape over the last year and a half since the Fed started hiking rates as aggressively as they had. There are so many underwriters, processors, loan coordinators, et cetera, that are out of work, that have had hundreds of applications submitted, and the robots either deem you worthy of speaking to a real human or not. And there's just no chance that a lot of those jobs come back until volume really ticks up pretty measurably. And as we talk right now, Sarah, we're looking at mortgage rates at around 6.8. They're climbing towards 7. And maybe that's because the MBS market is such a mess right now. Maybe that's because of fear over the debt ceiling deadline being something that they won't be able to reach. Maybe it's, over kind of more bread and butter Fed matters. Maybe it's all of it, right? And just the market is like, yeah, we're not we're not going to be buying any mortgages right now. We're going to be waiting a little bit until we see movement one way or another from the Fed or from the government. So that's where we are. So I think, even though we talked earlier in the program about being at the bottom would be if we miss the debt ceiling deadline and the U.S. government defaults. I know a lot of people don't put much stock in Zillow projections. Zillow have mortgage rates hitting like 8 point something if we end up missing the deadline. I think that's very, very possible. I also don't think that we're going to miss the deadline. I think it's too risky politically for all parties involved, and we haven't yet, even though crazy people have been in office for a long time now at this point, and yet, somehow good sense still prevails. So I'm still optimistic that they'll be able to reach a deal, and it won't be disastrous for the economy at large and also the mortgage industry. But it's still going to be a very difficult Q2.
I also think that, this is to your point. I mean, the Fed knew. I mean, housing went into a recession last June, and it was very predictable. And the Fed wanted it, right? I mean, the Fed wanted housing a housing reset, and what that meant to them was this section was going to take a ton of pain. And I just hope they're paying attention. This section has taken a ton of pain. How much more can it take and still survive? I mean, so I would say that, it's frustrating because who do you get mad at? I mean, the Fed is not somebody you can vote for. Fed is not,
Right.
go yell into the wind. But, basically it's like, I at least hope they understand the pain that this sector has taken for the whole country. Even last year when things were still pretty good in some other sectors, I mean, we saw a huge, almost overnight switch in our industry because of that, very aggressive rate hiking.
And the Fed has exacerbated, I think, a lot of the fundamental truths and problems in the American housing market at both extremes. So dropping rates to zero and creating this mad rush and resetting the board entirely with the housing market, I don't think it was a good policy. I understand their reasons for it. I understand that we largely survived COVID economically, and by a lot of measures, the economy is still doing well. And a lot of people would point to the Fed's actions as being largely responsible for that happening. But it completely re-engineered the housing market in America. And the other extreme of hiking rates, it's not even the hikes themselves that are the problem. It's the speed of which they
Yes.
raise the hikes, and that these businesses just cannot cope with such rapid movements, positive or negative. And the average family in a lot of cases can't either, right? And so now you have people who they missed that 18-month window or whatever it was, 24-month window, and they're just screwed. They're just totally screwed depending on the market you're in. So they've created a lot of extreme circumstances on both sides. And so some of the fundamental problems never even went away because they're not something the Fed has anything to do with. The biggest problem in America right now remains we have a massive shortage of housing, and we have a lot of people, current homeowners, who are disincentivized to sell. And we have a lot of existing homeowners who actively fight the construction of new housing anywhere in America. And we need smart policies. We need to figure out a way to incentivize people to sell. Maybe you wipe out capital gains for people who are, of a certain age or in a certain tax bracket or whatever, but something has to be done. This is not a healthy market for anyone, literally anyone, unless you already got your mortgage, you already got your dream home, you don't plan on having any other major life event or requiring, a move up or a move down or whatever. You're not moving to a new city. This is your forever home, and you're good. You won. You absolutely won. You can, be what is the cartoon duck that jumps in the pile of money?
Oh, Scrooge McDuck.
Scrooge. You can be Scrooge McDuck. And the gods have smiled upon you. For everyone else, it's disastrous.
Well, James, thanks so much for being on. Appreciate it. And we will talk again next week.
Thanks so much, Sarah.